Definition Gharar in Islamic banking. Gharar refers to uncertainty or risk that may cause harm. It is defined as ignorance in itself by Al-Salaksi and Al-Zailai from Mazhab Hanafi, while Ibn Abidin from Mazhab Hanafi and Al-Dusuki from Mazhab Maliki see it as a manageable risk in trade. The Mazhab Shafi'i define it as a high-risk khatar, and Al-Shirazi describe it as something unknown in condition and impact. Second, derived from the Arabic root gharar, meaning exposure to harm. It includes misleading other or risky exchange of unknown item. In Islamic law, gharar after vendor sale concept void due to potential disputes. It is categorized into two. First is risk involving doubt and uncertainty, and second, fault or crime by one party.
My name is Shahira binti Sulan and my metric number is A24A3213, and today I will be presenting about types of gharar in Islamic banking. So first point is buy and sell items that are not delivered. The element of gharar is the existence of the object of the transaction, and both parties know the existence of the thing to be delivered, but at the same time the contract is made and the seller is not carrying the item. So second one is buy and sell things that don't exist yet. An example of buying and selling gharar is when the thing sold is not available, which is like buying a calf in the stomach without wanting the mother, and also like eating a bird flying in the sky when it's not clear whether the seller can catch or not. So third one is buy and sell things whose price is not clear. The gharar element is the nominal price of the transaction object. For example, today a pair of shoes from brand X is sold for 200 ringgit when paid in full. But if you buy tomorrow, the price rises to 500 ringgit per pair. Otherwise, if you pay with the installment system, the nominal total will be 700 ringgit. Thus, it's not clear the exact price of a pair of these shoes because everything depends on the payment method and when the transaction made. Last one is buy and sell things that are not clear. Another type of gharar is a transaction without clarity of the nature of the object. An example you can find is selling mangoes that are still on the tree with the claim that the fruits taste sweet. In fact, the seller has not picked and tasted it yet.
Next, we move to the next slide that show you an issue in Islamic banking. First, uncertainty in contract terms. In Islamic banking, all terms and conditions need to be transparent and clearly defined to avoid any uncertainty, ensuring both parties know exactly what is being agreed upon. It refers to situations where the provisions in contract are unclear, ambiguous, or incomplete. It making difficult to determine the exact rights, obligations, and expectations of the parties involved. This uncertainty can arise in several ways and may lead to misunderstandings. For example, a bank offering a loan or financing agreement with unclear or ambiguous terms regarding repayment schedules, interest rates, or collateral requirements. Next, speculative investment. Contract based on speculative, high-risk bets or outcomes, such as gambling, may be termed gharar unless there is a clear and concrete basis for exchange. It refers to putting money into assets with a high risk and uncertainty in the hope of achieving substantial returns. The key characteristic of speculative investment is that they typically have an uncertain or volatile future, making them more prone to large swing in value. For example, a bank offering a financial product whose value fluctuates based on highly speculative market conditions would be considered to involve gharar. The last one is unclear risk sharing in profit and loss. Islamic finance supports risk sharing between parties, such as in musyarakah and mudarabah contracts, in which parties share profits and loss according to an agreed upon ratio. This refers to situation where the distribution of both profits and losses among parties involved in a business or investment arrangement is not well defined, transparent, or agreed upon. For example, a joint venture where one party does not know how the profits or losses will be divided can lead to ambiguous and injustice, which is a form of gharar.
Challenge in facing gharar in modern finances. There are various challenges that can be highlighted related to the issue of gharar. There are some of the main challenges faced in overcoming the issue of gharar in the modern financial world. First, we have uncertainty in financial product. In Islamic finance, this element is considered unfair and has a volatility to cause exploitations. For example, modern finances market often experience extreme volatility in volume, making it difficult to accurately predict the value of an asset or investment. This proves that the challenge is to determine how the product can be adapted to the principle of Islamic finance set by Sharia. This is a scientific challenge because it is necessary to identify and avoid product containing gharar in the transaction involving finances transactions. Second, we have this difficulty in Sharia interpretations. There are differences of opinion between Sharia scholars of various schools and regions regarding what is considered gharar in certain financial products. For example, in the context of takaful, most scholars think that the element of uncertainty can be accepted in certain form, while another scholar reject it completely. This difference of opinion makes it difficult for Islamic finance institution to develop products that are widely accepted. Third, we have innovation in product and service. This innovation often pose challenges related to the gharar because new products often involve elements whose Sharia status is difficult to ascertain. For example, Islamic credit card require complex adjustment to avoid the element of gharar and riba while maintaining competitiveness is conventional credit card. The challenge that can be shown is the process of adapting conventional product to Sharia requires additional time, cost, and expertise. This proves the developing of a product that is compatible with Sharia and it also able to compete the market is a challenge that need to be overcome. Lastly, we have education and awareness. A deep understanding of the principles of Sharia is the key to ensuring the interpretation and implementation of true Islamic finance. For example, many investors acquire gharar with referring to avoidable uncertainties such as unclear information or incomplete contract. This confusion can cause them to engage in transactions that do not comply with Sharia without realizing it. This shows the increasing education and community awareness is now a challenge that need to be faced. So the issue of gharar in modern finance is a big challenge that requires a comprehensive approach to ensure that Islamic finance remains relevant and more competitive. With this more strategic approach, modern Islamic finance now has a higher potential to play an important role in a more balanced global economy and ethical and more compliant with Sharia rule and general rule in country.
The negative effects of Gharar. There is 3 negative effects of Gharar, which is based on individual, country and society. So the first one is the negative effects of Gharar on individual, which is causing losses to the buyer. These things happen because when a seller does not use his thinking optimally when pricing an item, he takes the easy way by putting a high price to make a profit. The second one is negative effects of Gharar on the country. Gharar hinders growth and sustainable development of the global economy. When Gharar, which is fahish, is applied either in a contract or any transaction, it will cause the transparency of a national institution to be questioned. This is because Gharar fahish is included in the form of risk that is forbidden in Islam, namely risk that contain an element of extreme uncertainty. The last one is the negative effect of Gharar on the society. It causes hostility or conflict with the buyer. The existence of Gharar and speculative elements can cause buyers to be angry because they have been deceived by the seller. That's all from me. Thank you.
Today, I will present on how reduce the risk of Gharar in Islamic banking in terms of segregation. Okay, Gharar refers to uncertainty and ambiguity in contracts, which is prohibited in Islamic banking. I will share 3 ways to reduce it. The first is documentation and transparency. All the terms of argument, like product, price, delivery time, and payment must be clear. Transparency helps both parties understand their roles and avoid confusion. Example, in co-transaction, the argument must state exactly when and how gold will be delivered. So this can avoid unfairness. So the second is using approved Islamic contract. Contract like Murabaha, Salam and Istisna is clearly define what will be delivered, when and at what price. For example, a Salam contract specify the exact types and amount of goods to be delivered. This can avoid misunderstanding and keeps the deal fair. Lastly is Sharia compliance and regulation. A Sharia board for regulatory body should check all products to make sure they follow Islamic rules to avoid a Gharar. For example, Bank Negara Malaysia regulatory sandbox test finance product to ensure they are Sharia compliant and free from uncertainty or interest.
Okay, Assalamualaikum warahmatullahi wabarakatuh. My name is Siti Nur Atika binti Muhammad Hakim and my metric number is A24B2989. And today I will explain about how to reduce the risk of Gharar in Islamic banking in action. So we have 3 actions, which is contractual transparency, supervision and audit, and analyzing the provide goods and service. Okay, first I will explain about the contractual transparency. In Islamic banking, every contract or agreement should include price and comprehensive detail regarding the obligation, right, and term of each party. The customer should be truly informed to any hazard associated with the transaction so that they know exactly what they are getting into. For example, the bank must explicitly disclose the cost price of the items, the profit margin, and the accurate payment schedule when dealing with Murabaha product, which is purchase and selling with profit margin. Okay, next is supervision and audit. A Sharia commitment must monitor its Islamic banking transaction to make sure it adheres to Sharia principle and is devoid of Gharar components. Regularly auditing giving goods and service to make sure they do not contain any harmful component that could harm client or financial institution. This means that financing solutions that involve profit and loss sharing, such as those offered by Musyarakah and Mudorabah, must be audited to make sure that the percentage of profit and loss has been agreed upon equability and that all participants are aware of the risk and possible consequences. And the last one is analyzing the provide goods and service. Customers should select financial products free of elements of ambiguity, such as those involving speculation or any ambiguous payment structure. Strict question of banking instruments with speculation component, such as unclear directive transaction. There are predicted of gambling or speculation. Verify that the product you select comply with Sharia law. That means that the eliminate any element of confusing in an ijriyah, which is a rental contract. The bank must make sure that the right of the both of rental and the property owner are as follows, including what is rental and any additional fee. So that's all from me, and now I will move to the next presenter. Thank you.
In conclusion, Gharar is forbidden in Islamic because it's against the fundamental Sharia value of justice, fairness and transparency. Gharar is a key concept that is used to assess the legitimacy of risky investment, for example, gambling and short selling. Gharar can lead to circumstances where one party has an advantage over another, which can result in injury and exploitation. We can argue that Islamic financial transaction must be free from Gharar. This could investigate how this prohibition relate to real economic activity, equitable distribution of wealth and financial stability.